Property. The longer you hold it, the more you make. So why is it everyone throws it away? Let's think logically about this. And the reason I'm even doing this video is the amount of people that have it in their heads where it's like there'll be something and they use it as a reason to not invest. Now, you may notice one of my companies is Aspire Property Group. What we do is help people like you build their portfolios if they've got funding to invest on. And so the way we do this is instead of being like pitch, the idea is add a load of value, have a one-to-one strategic consultation call. So we spend like a full hour with somebody, understanding where they're at, where they want to get to and everything like that. And we've done it for a long time. It works really, really well without being salesy. We get a lot of clients, which is amazing. But there's always these clients go, I'm not sure about investing because, and they label the thing that's going on now. But I always say, if in doubt, zoom out. Okay, property prices in the UK have been measured since the Doomsday Book in 1086, which was when you could buy every piece of land in the UK for about £70,000. If you could go back, what would you do, right? Fast forward today, it's about 300, just shy of that. Now, 1,000 years of past doesn't guarantee the future, but 1,000 years is a good indication, I would say. So, the problem is, property is a long-term investment. So why would you have a short-term philosophy when you invest? It's kind of like, imagine you're a day trader trading in and out within minutes and then going, where's this going to be in 20 years' time? It makes no sense. So let's think about John the investor. If your name's John, it's probably not about you. All right, chill out. So if we go, if you could go back to Brexit and invest then compared to now in a good area, which is fairly logical, when would you invest? Today or 5 years ago? Okay, 5 years ago. What about COVID? Would you buy then or buy today? You'd buy then. What about Section 24? Would you buy then or buy today? You'd buy then. What about inflation when it peaked? Would you buy then or buy today? You'd buy then. Every single time. And I promise you, right now interest rates are quite high at the time of filming this, okay? They're not actually high, by the way. They're incredibly low. But they're high compared to what you could get 3 years ago. In a year's time, 18 months' time, do you think you're going to be saying, do you want to buy today or do you want to buy a year ago? I will put money on it right now. I guarantee, watch this video in a year and you will be saying, I wish I bought a year ago, okay? Because all of these microeconomies just don't matter when you zoom out and focus on the big picture. And if you're purchasing a buy-to-let that's looking to last the next 2 years, don't buy a buy-to-let property. Your exit should be death when you're buying a buy-to-let property, i.e. your exit is when you die and you give it to your kids and hopefully they don't lose half of it in their first divorce. All right? So, if in doubt, zoom out. Kind of leads me to my first major point, which is all about the stability of the market. Property is a very unique marketplace in the fact that it's very forgiving and it's also bilateral. And what I mean by that is it's got a multitude of approaches. So think about this logically. Let's say interest rates go up. Well, what happens when interest rates go up? It means that less people are going to be able to buy property. Now, as an investor, that shouldn't hinder you if you're smart, but most people are not smart. They follow what's in the media, the fear-mongering. Oh my God, buy-to-let's dead. I've been hearing it every year since I started investing 10 years ago. And I mean every year. So the point is, it's going to be there next year, 5 years, 10 years from now. It will always be there, right? So interest rates go up, less people buy. But answer this question, do those people that can't buy, they wanted to buy their house, but now they can't, do they suddenly sleep on the street? What do? No, they have to go and rent. But then if less people are buying properties to rent out in a market where there's an undersupply of properties already, more people need to rent than the stock's available, what happens to the rental prices? It goes up. And do you know what? Tenants don't really like landlords, and I think one of them's for this reason. So once the interest rate goes down, you're going to reduce your rents by a couple £100, right? No? I didn't think so. It hardly ever happens where rentals go down. So what happens is when purchases are affected, rentals go up. And then what happens is purchases go up and the demand goes up and property prices go up, so we benefit there. And then of course the average person can't buy that, so then they're forced into a rental market. And so it constantly goes like this. So when one goes down, the other goes up. i.e. rental goes up, but rentals never come down. And so we've got this market that goes like this, but is constantly on a pressure point over time, which is why if you see any graph and zoom out, you will see an upward trend. And you'll have years where it goes like that, but in general, up, 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 up. On average, you'll hear this all the time. The average property doubles in value every around 10 years. It's actually 10 to 12 years, or 7.9% on an annual basis, which is insane overall. But yeah, you want to be investing in something that is forgiving, has stability, and great infrastructure around it. The next thing we want to be looking at is the rental market. We want it to be favorable. And I think people massively overcomplicate this. But in general, there's going to be the data points that you want to look at in terms of quantitative data, which, by the way, if you want this for free, you can use Street Check. If you want a really, really good version of this, then you can use property data. And what we'll do is we'll put a link in property data in the comments and pin it to the top, because we've got something where you can get it free for 2 weeks and then check it out. So property data, pretty good. But in general, you're going to look at something called the tenure of property, or think about it as ownership versus rental. Now, the UK has about 60% owner occupier, and this is broken down into roughly 30% owned outright. There's no mortgage on it whatsoever, and then 30% is owned with a mortgage. Then you've got about 21% private rental sector, so private rents, and then you've got around 19% social housing, so council tenants, assisted living and stuff like that. So in general, 60 plus the 21 plus the 19, 100%, right? So if you're looking at your area and it has 70% owner occupier, that's going to indicate stronger capital growth. If you've got stronger than 21%, let's say it's 29% private rental, that's going to be really strong rentals. Often when you see an increase here, you see an increase here and a drop here. If you've got an area where social housing is 30%, for example, it's likely to be a bit of a rougher area. On paper, you'll make more money, but you probably won't, but we won't go into that into this video. So in general, I'm looking at areas that has a good rental sector that's going to get that demand. So that's the obvious part in terms of the data. But then I'm looking at something that maybe can't be quantified as much, is infrastructure. Okay, infrastructure. So I'd be thinking, why would somebody live here? And this is where you need to think of your end customer, right? So if it's got hospitals, if it's got trains or buses, if it's got maybe a local A road or a motorway, if it's got schools, specifically schools that are good or outstanding, quite important there, by the way, you're probably going to get a family moving in for a long term. So this is the infrastructure thing that I'm looking at over the basis. Now, I'm very fortunate in Leeds, which is my main area, Leeds and surrounding. We actually had the highest capital growth and rental for 2023. So that's really good, and a lot of that, and by the way, other areas are great too. Obviously, I love Leeds, and that's cool validation for it. But a lot of it is due to this sort of thing. So you want to make sure you've got rental stability. Number 3 is capital gains, or capital growth, or capital appreciation. So as I said, the long-term average is 7.9% over in the UK. But we want to be focusing on beating this. But even if you were conservative and said 5%, that's going to be really cool over the long term, because say you've got a £200,000 property, most people think their money is going to come from the rents. Not really. About 20% of your money comes from rent, about 80% comes from capital growth. And the reason for this is because of debt, leverage, right? So you're not going to have £200,000 in this property in the long term. You'll likely have about £50,000. So if you've got 50 grand in this property, then what we're going to be doing, obviously there's fees and stuff like that. If you get a 5% increase each year on 200,000, that's £10,000. Now again, I know there's fees, stamp duty and stuff like that, but just for the simplicity of this video, you've got £10,000 increase on your net wealth over your cash. This is your deposit, by the way, DEP. 50 grand deposit. If you do 10,000 divided by the 50,000, that equals a 20% return in your net wealth, okay? Now, that's only a stable way of looking at it. That's only one way of looking at it, of course, and it's on paper. But taking out of fees, that is a huge return on your money. If you went to the average person and said, I can get you 20% return, that is absolutely crazy, all right? Now, in general, is it gonna get 20%? Maybe not, but imagine you get 13 to 15% every single year through capital appreciation. And again, this actually comes back to that key word again for me, which is infrastructure. I'm probably spelling this massively incorrectly, but I don't care. Infrastructure is super important. Now, think logically. If you are trying to buy a property and you don't have any competition, that is a red flag for me. If nobody's competing for the property, I don't really want it, because if I ever needed to sell it, and there's no competition, then you're going to be screwed, right? But also, valuers that go out, surveyors that go out to value the property, they know the demand in the area. We want it to be somewhere that's really good. So where do people want to live? Why do they want to live there? Leeds is a really big one right now because of London getting so expensive. You might have noticed this. A lot of people from London and Kent are moving to Yorkshire. And you're like, what? That's such a big move. Well, it's not when you know that Leeds is the second biggest financial centre in the UK outside of London, right? So if people are going to move from London and they want to be in a financial district, Leeds is the next obvious choice. Number 4, tax. Now, here's what happens. Let's take this £200,000 property, and let's say over a 5-year period, and no, before the naysayers say, I'm not saying every 5-year period ever. I'm saying the average 5-year period, let's say we get 40% growth over 5 years, not per year. We're going to get £80,000 in added equity. Okay, that's not like huge, it's not life-changing, but imagine just per property and you're building a portfolio through time. Well, you can release 75% of that by remortgaging, getting a new mortgage on the property, which is £60,000. Now, it's not huge until you go, okay, well, let's divide that by the 5 years. Well, that 5 years is going to be, when you break it down, 12 grand a year, divide that by 12, obviously 12 months, that's £1,000 every single month. It's not going in your bank every month, it's one big refinance. Now, if you were me, I'd then reinvest that. But here's the thing, that is absolutely tax-free. And by the way, this is how the world's richest, I'm talking like hundreds of millions worth of net wealth. They do not have hundreds of millions in their banks. I promise you, I don't know loads, to be fair. I may know between 5 and 10 people at that level. I don't know many billionaires, so I'm not trying to make out that I do. But every single one, they are asset rich and relatively cash poor, because when they want 5 million, 10 million, all they do is go to the bank, usually a private bank like Coutts or something like that, go, I've got these assets, give me 10 million quid. They go, yep, no worries, here's 10 million, and they put a charge against their property. It's all debt free. And then you've got inflation eroding the value of that £10 million loan, interest rates getting covered by the increased rents that are higher then, and no tax to pay on any of that money. That, and maybe I should do some videos on tax, let me know if you want, but not a financial advisor at all, by the way, just what I do and my opinion in this, but that is how you get truly wealthy. So hopefully that's been interesting for you. Let me know what you thought of the video in the comments. As I said, if you're ready to invest, put APG in the comments and we could just book in a one-to-one call. It'd be amazing. Or click the link in the comments that's pinned to the top. If you're new to the channel, by the way, we've got a lot of stuff coming up that's going to be for subscribers only. So make sure to hit subscribe and the notification bell, and you've got some really cool stuff coming up in the next couple of months. And of course, if you did get value from this video, make sure to lightly tap that like button, and I'll see you in the next video.